Hello everyone, welcome back to our channel, where we break down the world of money, markets, and the signals that shape our financial future. Today, we're diving into a topic that's both ancient and incredibly relevant right now. Today, we're talking about your money and the future. More specifically, we're exploring how the movements of precious metals like silver can reveal what's really happening beneath the surface of the global economy. Gold and silver have always been economic warning signals. They're not just shiny objects or collector's items. They're like the canaries in the coal mine for our financial system. When their prices spike, it's a sign that something big is about to happen. These sudden jumps aren't random. They're reactions to deep shifts in trust, policy, or stability. Throughout history, when people lost trust in paper money, they turned to gold and silver. It's a pattern that repeats itself whenever uncertainty rises or currencies start to wobble. In ancient Rome, when the government debased its coins, mixing in cheaper metals to stretch their value, gold and silver prices tripled. This happened right before a massive economic reset that changed the course of history. People instinctively knew something was wrong, even if they couldn't see it on a chart. The same thing happened in 1931 Britain. As the pound collapsed, gold and silver soared, signaling the end of Britain's dominance as the world's financial center. Investors and everyday people alike rushed to protect their savings. These metals don't cause crises, they warn us about them. They're like flashing red lights on the dashboard of the economy, alerting us to trouble ahead. Fast forward to today. When silver's price triples in a short time, it's not just a number on a screen, it's a global alarm bell. It means people everywhere are worried about the value of their money and are seeking safety. People are worried about their money and the economy's stability. They're watching the news, checking their accounts, and wondering what's coming next. These feelings are real, and they're reflected in the price of silver. These price surges are messages from history, telling us to pay attention. Every time silver or gold makes a dramatic move, it's echoing the lessons of past crises, reminding us that nothing in finance happens in a vacuum. The lesson? When precious metals move fast, something fundamental is shifting. It could be inflation, political turmoil, or a loss of faith in the system itself. These moves are never just about metal, they're about trust. Don't ignore these signals. They're not just for traders or economists, they're for anyone who wants to protect their savings, understand the world, and make smarter decisions for their family's future. They're for anyone who wants to understand what's coming. By paying attention to these ancient signals, you can be better prepared for whatever the future holds. History is whispering to us right now. The question is, are we listening, and are we ready to act on what we hear? Let's look at what's happening right now. 2 years ago, silver was $22 an ounce. Today, it's over $74. That's not a normal increase, it's an explosion. This signals a loss of faith in the US dollar. When people doubt the dollar, they run to real assets like silver and gold. Silver's surge is a vote of no confidence in paper money. It's a warning, like a canary in a coal mine. This isn't just about silver, it's about the foundation of our economy. When silver's price triples, it's a sign of deep instability. Don't panic, but pay attention. The financial world is sending a message. Understanding this is the first step to protecting yourself. What's driving this fear? One word: debt. But it's not just any debt. It's a tidal wave of borrowing that swept across every corner of American life, from the halls of government to the boardrooms of corporations, and even into the living rooms of everyday families. This isn't just a financial issue, it's a problem that touches every American, whether you realize it or not. America's debt, government, corporate, personal, has grown much faster than the economy. While the nation's productivity and wealth have increased, the amount we owe has ballooned at an even faster pace, creating a dangerous imbalance that threatens long-term stability. In the 1980s, total U.S. debt was 160% of GDP. Now, it's 400%. That means for every dollar the country produces, there are $4 of debt attached to it, a staggering shift in just a few decades. After the 2008 financial crisis, government debt exploded, now over 124% of GDP. The government borrowed heavily to bail out banks and stimulate the economy, but the debt never shrank back down. The government took on private debt, but just shifted the problem. Instead of households and companies owing the money, now it's the taxpayers and future generations who are on the hook. Unlike you or me, the government can print money to pay its bills. This might sound like a magic solution, but it comes with serious consequences. Printing more dollars makes each one worth less. Currency devaluation. As more money floods the system, the value of every dollar in your wallet quietly erodes. Investors see this and worry their dollars will lose value. They know that when a currency weakens, savings and investments can be wiped out by inflation. That's why they're rushing into silver and gold. Precious metals have always been a safe haven when paper money looks shaky. The mountain of debt is a warning sign. It's a signal that the system is under stress and that big changes could be coming. When governments print to cover debt, everyone's money is at risk. It's not just investors or bankers. It's every person who earns, saves, or spends dollars. This is the real reason behind the historic surge in precious metals. People are looking for safety, for something real that can't be printed away. The fear isn't just about debt. It's about what comes next. Will inflation spiral out of control? Will the dollar lose its place as the world's reserve currency? No one knows for sure, but the anxiety is real. And that's why you should care. Because the choices made today will shape the financial future for all of us, and understanding the risks is the first step to protecting yourself and your family. There's a powerful link between U.S. government debt and gold prices. When the government borrows more, it sends ripples through the entire financial system, and gold often becomes the asset investors turn to for safety. This relationship isn't just a coincidence, it's a pattern that's played out time and again in economic history. For the past 20 years, as government debt has steadily climbed, gold prices have closely followed, almost like a shadow. The more the debt grows, the more investors look to gold as a store of value, seeking protection from the risks that come with rising obligations. Why does this happen? Investors know that when debt piles up, the government faces tough choices. Instead of raising taxes or cutting spending, it's often easier to print more money. This approach may seem simple, but it has serious consequences for the value of the dollar. Printing money devalues the dollar, so people buy gold to protect their wealth. As the purchasing power of paper money erodes, gold stands out as a timeless hedge, offering stability when currencies falter. Gold can't be printed, its supply is limited. That scarcity is what gives gold its enduring appeal, especially in uncertain times. Unlike paper money, gold's value isn't at the mercy of government policy. As debt grows, so does the urge to own real assets. Investors seek out tangible stores of value, like gold and real estate, that can't be created out of thin air, providing a sense of security when financial markets are volatile. This isn't just a theory, it's a trend proven by the last 2 decades. Time after time, the data shows that as debt balloons, gold prices respond in kind, reflecting growing concerns about the future of the dollar. Silver, often called poor man's gold, moves for the same reasons. It's another precious metal that investors flock to when they worry about the stability of paper currencies. The recent surge in silver prices is an urgent response to runaway debt and inflation fears. Investors are looking for alternatives, and silver offers a more accessible entry point than gold. Investors aren't just worried, they're taking action. They're moving their money, shifting portfolios, and seeking out assets that can weather economic storms. The message is clear. As debt rises, trust in paper money falls. People lose confidence in the dollar's ability to hold its value, and they look for safer alternatives. Precious metals become the safe haven of choice, offering protection and peace of mind when uncertainty is high, and the future of the dollar is in question. Here's the strange part. While gold and silver soar, most other prices are flat or falling. Oil and wheat prices have dropped 30% while silver tripled. Housing prices are flat. This isn't normal inflation, where everything gets more expensive. Instead, it's a crisis of confidence in the currency itself. Investors aren't buying silver for industry, they're buying it as money. The real economy is weak, but financial fear is strong. Soaring metals and weak commodities mean instability. This isn't about booming demand, it's about escaping a weakening dollar. The divergence is a warning. The economy is on shaky ground. Pay attention to what's rising and what isn't. Let's talk about the velocity of money. How fast money moves through the economy. High velocity means money changes hands quickly, fueling inflation. Low velocity means people are holding on to cash, not spending. Right now, U.S. money velocity is at historic lows. That's why all the money printing hasn't caused massive inflation, yet. The money is stuck, not circulating in the real economy. But if people lose faith and start spending fast, velocity jumps, and prices can explode. We're not there yet, but the risk is real. The only thing holding back inflation is slow money movement. If that changes, expect prices everywhere to surge. Silver's warning: be ready for a shift. So where's all the money? It's locked in financial assets, stocks, bonds, investments. The stock market is at record highs, but that wealth is mostly on paper. Most of the new money since 2008 is trapped in this financial loop, not spent in the real economy. The rich hold on to these assets, so the money doesn't trickle down. This creates a disconnect: soaring markets, weak real economy. Money moves from stock to stock, now from stocks to hard assets like silver. But it's not reaching everyday people. The system is balanced on a knife's edge. If something unlocks this money, it could flood into the real world. That's when things could change fast. The big risk? A loss of confidence in financial assets. If the stock market crashes, paper wealth vanishes and panic sets in. People rush to buy anything real: gold, silver, land, food. Money floods out of investments and into the real economy. Velocity explodes, and prices for everything skyrocket. This is a true currency crisis, sudden, chaotic, and devastating. We're not there yet, but silver's surge is a warning. Big investors are already moving to hard assets. For everyday people, this is your early alert. When trust breaks, events move fast. Be prepared. So, what can you do? You can't control the economy, but you can control your own finances. Panic isn't a plan. Education and action are. First, get out of high-interest debt, especially credit cards. In a crisis, those payments could become unmanageable. Second, build an emergency fund. 8 to 12 months of expenses, safe and accessible. This is your lifeline if things get tough. Third, keep learning. Understand assets, liabilities, and different investments. Don't rush into anything you don't understand. The surge in silver is a wake-up call. The financial world is changing. Be ready. By staying aware and building a strong foundation, you can face the future with confidence. You have the power to prepare. Start now.